As I record this video, the market's currently at all-time highs. And if you're curious what financial advisors are telling their clients, stick around for this video because I'm going to let you inside of the tent. I've been a financial advisor now for over 20 years. I've helped guide hundreds of families into retirement, and this is what I'm telling my clients as we're at all-time highs. And the first thing I'm telling my clients is to remember that anything that goes up by 10%, 20%, 30%, I'm not saying the market's up there as I'm recording this, but anything that goes up by that amount can also fall by that amount. So, and don't think of it as percentages. You know, anything that goes up 10% can fall 10%. 10% moves for most, don't spook most people. Most people view 10% moves as a buying opportunity. What starts to scare people is when the moves get to 20%, 25%. So let's say you've got a $500,000 portfolio. What I tell clients is don't think of it as 25%. I want you to think of it as your $500,000 portfolio just lost $125,000. Actually, I actually slide an envelope across to them. And the first envelope is what their current balance is. And then let's say today's Q1, the first quarter of the year. Then I slide them an envelope that says Q3 on it, the third quarter of the year, which would be, what are we doing? July, August, and September. It says Q3 on it. And there the account's only worth $375,000. So it lost $125,000. And I asked them to think about that. How does that feel? And you know, for a lot of people, they remember how long it took to save $100,000. And often that conversation is, you know, this took us 15 years to save. This took us 10 years to save. We had to sacrifice. We were 30 years old before we saved our first $100,000. So I try to make it real, and I want to encourage you to make it real, because the next few steps are going to take some discipline. And it's easy to not make any changes when you feel like a genius because the last 15 months, the last 18 months, the market's been doing really well. But you can't protect yourself if you don't make some changes. And I should say, none of what I'm going to share with you today is financial advice. I don't know your situation, so I cannot give you financial advice. Okay, let's jump in. So the first thing I do is I get them to think about the magnitude of the loss in dollar terms, and frankly in effort and sacrifice terms, and then also in terms of years. How many years did it take? And so why do I do that? Because the very first thing I want to do is I want to revisit their asset allocation. When clients call, let's say that there's a 30% stock market drop, I'm just making up something, I have no way of knowing, of course. In 2025, there's a scary market drop. And a client calls up and says, hey, Azul, what are you doing to protect me from this market drop? And the candid answer is, what we're doing to protect you is what we did 3 years ago, 5 years ago, 7 years ago, which is your asset allocation. Your asset allocation is what protects you in scary times. But you can't change your asset allocation in the scary moment, because that drop, you can change it, but that drop's already taken place. So now you're selling low. And wouldn't it be nice for once to sell at a high, right? I'm going to come back to that point, by the way. But so you do the asset allocation when you're thinking clearly, when there's not a lot of scary things going on that are keeping you from sleeping, when you're not suffering from anxiety, which is an acute level of worrying. It's keeping you up at night, and people are like, I just can't take the pain. The time to revisit your asset allocation is when times feel good, where it's easy to do that. And then I encourage my clients, just like I did you here, wouldn't it be nice to sell at a high? So you're revisiting your asset allocation. Does it make sense? Now, those of you getting close to retiring, I want to caution you, even if you're 5 years away from retiring, how you look at risk is going to be very different once you're retired. I know people that were able to stay the course through the dot-com bubble, through the great financial crisis, through the first 2 months of COVID, which was the fastest stock market drop in U.S. history. They were able to stay the course through all those periods of time. But just because they've been able to do that in the past when they were making a good salary and adding to their savings, it doesn't mean that they're going to be able to stay the course, that it's not going to cause them a lot of mental anguish when the stock market crashes. It's eventually going to crash again at some point, but when the stock market has a big decline. So you're going to feel differently about risk. So take that into consideration. If you're going into retirement and you're at this level of risk and you're like, well, I've always been comfortable with that. Well, just buyer beware. How you feel about risk is going to change. So the second thing I talk to clients about is revisiting their asset allocation. The next one that's critically important, and even if we leave the asset allocation alone, when the stock market's had an 18-month strong run, we probably need to rebalance, right? The stocks have appreciated and have become a bigger percent of the portfolio than what the game plan was. Now, when you're working with a professional, they're likely doing that for you a couple times a year. So I mention this to you just as a reminder if you're running it yourself, your own money. I want you to just remember that to rebalance, because you might have said, I want to be 60-40. I'm just making up numbers. 60% of the stocks, but because the stocks have done so well, you might be 70-30 now. And again, wouldn't it be nice to sell at a high? So if you need to rebalance, if 60-40 is the right number, then stick to 60-40. Don't let creep take place. Be active, be disciplined, be proactive. Okay. The next thing to think about that frankly is not on a lot of people's radar screens is the potential, if you have charitable inclinations, let's say you have some charities in town or a church that you support, and you give a couple $1,000s a year to charities, whatever the number is. If you were to sell a stock that has gone up in value and you've held it over a year, you're going to pay long-term capital gains tax on that. But you can donate that money either directly to the church or the not-for-profit. Oftentimes you can do this. Or you can use a tool called a donor-advised fund. I just want to put that on your radar screen. A donor-advised fund is a very simple account that custodians like Schwab, Fidelity, I believe Vanguard has one. It's a very simple tool that allows you to take, let's say you have a stock that you bought for $3,000 and it's now worth $5,000, right? And you've held it over a year, which is an important piece. You can donate that to the donor advised fund, but you don't have to decide how much you're going to give away and to whom you're going to give it away. So look it up. It's definitely worthwhile looking at because it allows you to get that charitable donation today, but delay the decision of who's going to get that money and how much money. Now, a word to the wise here, a caution, is if you have a donor advised fund, make sure you have what's called a contingent advisor. So let's say you're married and you and your spouse are the current owners of the account, and let's say you were to pass away, who gets that money? Who makes that decision of where that money ultimately goes to the charity? So you want to make sure that there's somebody that is what's called a contingent advisor. Most people would put their kids. So anyways, that's on a donor advised fund. A lot of people don't think about it, but when asset prices are high, oftentimes making donations to charities. Why would you want to do that? Because the charity doesn't have to pay capital gains. So in my example, you bought something at $3,000. It was 2 years ago, so you've held it over a year. It's now $5,000. You give that to a donor advised fund, you have access to $5,000 to give away. If you sell that stock and then give away the proceeds, you have only the after-tax proceeds to give away. So hopefully that makes sense. Okay, earlier I said, wouldn't it be nice to sell high? So when the market's at an all-time high, I want you to take a disciplined approach, a disciplined look at each and every one of your positions. Are there any positions that you own that you're uncomfortable with? Because if you're uncomfortable with it now, when the market's doing well, boy, you know what? If the market drops 15, 20, 25% or more, you're going to be super uncomfortable with that. And most people, if they're uncomfortable in the good times, are going to be even more uncomfortable in the bad times. So if you feel that way, I think it's worth thinking about how are you going to feel if the market goes down and that position is down 20% from where it's at now. If you think you would sell it then take a critical eye and give some serious consideration to maybe you sell it now and you, again, enjoy selling high. So these are the things that I think you need to do when the market's at an all-time high. I think you also need to enjoy your journey into retirement, and that's what this video is up here. 7 things that I want you to stop doing in your 50s on your way towards ultimately retiring, on your way to that starting line called retirement. I'll see you in that video. Thanks for watching this one. Bye-bye.